You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, chatting today with Dave Kranzler from Investment Research Dynamics. It's been quite a while since Dave was on the show. Dave is also the editor of the Mining Stock Journal, and he's covered mining stocks in that journal for at least 8 years, right, Dave?
Let's see. Yeah, I started it in early 2016, so 7.5 years, whatever.
And then you started buying silver at that point too, when you were a trader at that point, right?
No, at that point I had actually left Wall Street, moved out to Denver, where I'm from. But yeah, I bought actually bought gold first. I paid $300 an ounce for Austrian Philharmonics.
And you still own them? Same ones?
I do. Yep.
So you own it, you have to have it in your possession, and you hold on to it. And I think you were buying silver at $5, if I remember from a previous conversation.
I think my first silver was $5. I think the bulk of it's under 10 for sure.
All right, so the banks are collapsing, but it seems to be it's just the regional banks at this point. You know, is this a controlled demolition to filter us into the top 6 banks? What do you see happening here, and how does this affect us as junior gold speculators?
A lot of people might think what you just suggested is conspiracy theory, and I've put some thought into it. I don't know if that's what is really going on behind the scenes. Certainly, what's going on isn't what we're seeing in mainstream media and on TV, right? I mean, Jay Powell assured us last Wednesday that the banking system was safe and resilient, and right after the stock market closed, and after he was done with his FOMC press conference, I think it was PacWest or something, announced that they were evaluating options for raising capital or an outright sale. We had another down leg, so that doesn't reflect a safe and resilient banking system. Again, I mean, I don't want to go into the conspiracy theory tall weeds, but I would not rule that possibility out, that this is a way for them to consolidate banking assets and deposits into the large money center banks in New York, and that are members of the New York Fed. I mean, we all know the New York Fed is by far the most powerful of the regional banks. I don't know if you ever read the Creature from Jekyll Island.
I haven't read it. I know parts of it, but I have not read the book in its totality.
I mean, for people who think that this might actually be a stupid conspiracy theory, they need to read that, because G. Edward Griffin has done remarkable research in putting together that book about the founding of the Federal Reserve. And one of the reasons why it was erected was that the regional banks were taking a lot of market share away from the New York money center banks. And so it was a way for the New York money center banks to sort of not monopolize, but maybe create a banking oligarchy and put some of those regional banks that were taking their business away out of business. So whether that's what's really happening or not, it's happening, and I don't think we've seen the last of it. So the Fed dumped $400 billion into the banking system, not with direct QE, but with support facilities and things like that, and that's starting to come back out. And that's what I think gave the illusion of stabilization. And that's also what I think has driven this latest leg in the bear market rally that's been going on in the stock market.
Dave, I have some friends that I talk to frequently that they're planning for a late summer, early fall potential severe crisis. That's how they're positioning their finances. And when I was chatting with one of them, I said, listen, brother, we've been talking about this since 2009, right? We've been expecting financial Armageddon since 2009. I said, what makes this the time that you really think it's all going to come down? And they said, hey, he linked to intuition. He said all the signs are there. And I said, yeah, but a lot of the signs have been there for the last 10 plus years that we've been talking about it, right? I guess what I'm saying, Dave, is I could see it collapsing, but at the same time, I can't believe they've held it on this long. So for someone like me, what would you say?
I mean, I don't like to put a timing on it. Like, I'm not going to say the end of the summer or fall. I mean, that's usually when bad things seem to happen to the financial markets, right? In terms of their ability to hold it up, part of their ability to do that is because the dollar has been the reserve currency and everyone around the world has to take it. So there's always demand for it. So a lot of that money, I mean, they printed almost $9 trillion between 2008 and early 2022. So they printed almost $9 trillion. there's other mechanisms that have provided liquidity in the global markets and the U.S. markets besides just the QE. And then you got the U.S. government's been able to keep growing its debt load, again, because of the rest of the world that had been considered the safest place to park your money, right? Treasuries. But now we're seeing big parts of the rest of the world divesting treasuries. I'm sure this debt ceiling crisis will be resolved by either suspending it or lifting it. But at some point, the world's going to stop accepting dollars. And we're starting to see that movement now. And that's at the point where money printing won't hold things up the way they've been holding it up. And whether that happens sometime in the next 4 or 5 months, I have no idea. I mean, I honestly am expecting another big down leg in the stock market sometime in the next 2 or 3 months, but I don't know if that's going to be the big one. It's going to be one of those things where we're not going to be able to see it coming, and we're going to be blindsided by it. And all of a sudden, it's going to be a gradually then suddenly situation, right? Where we know it's coming, we just don't know when. And when we least expect it, boom, that's when it'll hit.
So if it's a gradually then all at once expectation, which I agree with, how does that affect gold stocks? With some people I know, they're minimizing some of their exposure to the more speculative side of the gold stocks in order to build up cash for what they think is a crash. How are you navigating what you see in the macroeconomic level as it relates to your junior gold portfolio?
Sure. Well, I mean, first and foremost, I would recommend keeping the money that you have allocated to the precious metal sector. People would probably be shocked if they knew what my percentage is. Let's just say it's way greater than 50%. But the majority of that should be in physical metal that you safekeep yourself. I mean, it's okay to use custodians for some of it, but the problem is that when the big one finally hits, I think you're going to see custodians for all types of assets just shut down or implode. If I'm right, that would suggest that owning any stocks, let alone mining stocks, is not going to be a good place to be. Again, when you keep your assets or your money with a custodian, you're one step removed from it, and you're exposed to the risk, the custodial risk, the risk that custodian goes out of business. And if it's a bank and you're in an insured account, yeah, you're going to get your money back, but it takes a while. It doesn't happen all at once. I think the market is probably going to sniff out what's coming before we see it, the general market. So we'll see precious metals rise, which we saw over the last few weeks during, when all the dust was being kicked up with the regional banks, and the mining stocks followed. And I think what we'll see, I think we're going to continue to see gold and silver rally, and that's going to push mining stocks higher at some point. The juniors have lagged, and at some point, and for me, that's the classic bull cycle where you get gold and silver moving first, the largest cap gold miners moving, and we saw that. You look at the Amex Gold Bugs Index or the Huey, that was outperforming the rest of the sector for a while. I think GDX has actually been, and that's smaller, slightly smaller cap than the Amex Gold Bugs Index. A lot of the juniors have just gone sideways. But if you look at the charts, they're forming nice bases, and some of them are moving up. They haven't all been dead. Some of them have had some nice returns on them over the last 6 months. So I think what we'll see, before the big one hits is the precious metal sector will go crazy, and the mining stocks will go crazy times 2 or 3. That's usually how it works out. And the trick is, if you really think that you're exposed to custodial risk with your stock accounts, you got to figure out when you're going to sell them and get your money out, before they blow up.
Are you of that camp, or in terms of you have to have the physical stock certificates, or timing it to get it out before you think a broker might go down?
No, I would just take your cash out and buy more gold and silver. I used to be in that camp, and part of the motivation for it was, and Jim Sinclair was the one who really drove the thinking on that for our people in our sector. And part of that was just to get your certificates and hold on to them so that they can't be borrowed and shorted. And part of it was, it removes custodial risk. But if we really have the type of crisis or collapse that collapses the custodians, I don't know why people think they're mining their stock certificates, whether it's mining stocks or whatever, some tech stock certificates. I don't know why people think that that's going to give them value. I mean, a lot of these businesses will be out of business. They won't be able to operate. And it'll take a long time before the dust settles, if it settles, and normal business activities resume. So I think you're just better off, if you're starting to feel uncomfortable with the markets and you're worried about what might happen, I think you're better off just moving everything into cash and getting it as much as you can out of custodial safekeeping.
The last couple of years have been difficult for us junior precious metal speculators and the miners. Has that changed your outlook, or you're giving you new criteria for what you look for in a junior these days?
Really? It's been difficult for you?
Just a little bit.
It's been tough. It's been tough. We've had a couple periods of really nice returns since 2016 started, right? We had nice returns for the first 8 months of 2016, and then sell off. And then a really nice pop in 2020. Of course, that was helped fueled by that $4 trillion the Fed dumped into the system. And then we had been in a downtrend since August 2020. There's been some fits and starts. And I think we probably bottomed out in September, October of 2022. So, and I think the current pullback that we're in is a healthy pullback that'll set up the next move higher. In terms of the criterion that I use when I look at, and this is primarily for the junior microcap exploration or junior development companies, right? So market cap's well under 100 million, and they've got a project that they're looking to advance, and the stocks often sell for 10 cents, 20 cents. And if you pick out the right ones, you've got potential for a 5x or 10x on your, or in some cases even more, like Silvercrest Metals. But I don't know that it's necessarily changed the criterion that I use when I'm evaluating companies like that. I will say that over the last couple of years, I've become a lot more sensitive to jurisdictional risk. So probably the number one criterion is, if I'm looking at a company with a project, is a low risk jurisdiction. And that's relative term. Even the United States, which people consider to be relatively low risk. You talk to junior executives, they're like, no, there's a lot of risk involved with developing a project in the United States, not the least of which is dealing with the BLM and trying to get an environmental permit. So, and even, Canada's probably the most jurisdictional friendly for precious metals miners. The second thing I look at is if I decide, okay, I'm going to take a look at this, what's the DNA of the project area, right? Are there other projects that are being successfully advanced? Are there mines that are operating in there? Because in that, I'm not a trained geologist, and most people who invest in these things aren't. But if there's other companies that are taking deposits from that area and extracting it, then it suggests that, assuming the geology is similar for the project you're looking at, it suggests that, you probably have amenable metallurgy, right, of the geology, which means you can actually economically extract the mineralization. I really don't like to go invest in evergreen projects, meaning projects that are greenfield, where there hasn't been any exploration. You get a company, we just leased claims, or we acquired claims in this project in this area, and we're going to start exploring it and drilling it. And, I like the company to be, or the project to be slightly advanced, whether it's field work and ideally, preliminary drilling, because that's, you can have a project in the middle of the largest gold mines in the world, and there's a reason why that property is available, because there's nothing there, and you don't know if there's anything there until you start drilling. So I like to have some evidence. This is really important for me, and it's not a deal breaker, but I like to see high insider ownership, at least 10%, because if I'm going to put my money into something, I want to see that management is also doing the same thing, because it also reflects the degree to which they believe in the project. Another one that's, again, it's not a deal breaker, but I do like to see a low share count, because, as you know, when you're advancing an early stage project, it takes a lot of capital to do it. And, people whine about stock deals to raise money, but how else are they supposed to raise money? They're not going to walk into JP Morgan and get a loan to start drilling a project, right? So I do like to see a low share count. If you come into a company that has what looks like a good project and they've got a high share count, and they've been around for 8 or 9 years, it probably means they've made a lot of mistakes. So and that's another thing I do, is when I'm looking at a company for the first time, one of the first things I do is I go through their news feed from the very beginning because I want to see where it came from, who's involved, whether they've done reverse splits. Reverse splits often cover up gaping wounds in the company. So, and then again, ideally, it's not a deal breaker, but ideally I like to see the company have 12 months of cash based on their current burn rate. Because that way you kind of, at least you know that they'll have enough cash to go through a drill program. And if they hit a discovery, the next round of financing will be at a higher stock price. I don't like to be invested in companies that keep issuing stock and they keep dragging you along. Oh, look at these drill results, and it seems like it takes forever. And all of a sudden their share count goes from 50 million to 250 million and the stock's gone nowhere or down, so I try to avoid those situations.
And what would be some companies that meet this criteria? Would you be willing to share some picks that you have?
Sure. And just for the record, my newest ideas, I embargo for my subscribers. And again, another criterion that I like to use, and it's getting harder as the audience of mining stock and precious metal sector investors expands. I mean, there's so many more investors, retail investors, institutional now than there was in the early 2000s. So it's getting harder to find and uncover ideas that already don't have a lot of eyeballs looking at it. But one I've mentioned in the past is Viva Gold. I don't know if you remember that one or...
Yep, Nevada, yeah.
Yep. So they're developing an open pit heap leachable project in Tonopah. It's a smallish deposit. I mean, right now I think they have 650,000 ounces of measured, indicated, and inferred, but it's relatively high grade. And I know the CEO really well, and he's done several of these projects. He's done every phase of mining, from greenfield project development to converting it into a mine. And there's a lot of times a separation between the geologists who are always optimistic and developing a project, and they don't necessarily think about the logistics of, okay, well, where are we going to source power? Where are we going to source water? Once we've extracted our gold or silver, how are we going to transport it to refineries? I've learned a lot from him, and he's been involved with all aspects of that. And quite frankly, this is probably one of the most straightforward projects to get from where it is now to get it converted into a mine. And it's probably going to happen within the next 18 to 24 months, barring some, there's still risks here, but there's not a lot of risks. So barring, a meteor falling and hitting the project, say, hey, this is as sure a thing as anything I look at in terms of getting it from where it is now into an operating mine. It's a very low cost and easy to build mine. Like I said, it's heap leach open pit. And honestly, I think there's a chance, because in the Walker Lane trend, there's been a lot of M&A activity recently. And there's been some comparable projects that have been acquired by AngloGold Ashanti and Centerra. And if you look at what they paid for those projects, they weren't mines. They were basically projects in similar phase as Viva's Tonopah project. It would value Viva at somewhere between 100 and 150 million. And that's based on how far along it's advanced, how much it's de-risked, and how much gold it has in the ground.
And what's the current market cap?
Viva's market cap right now is it's about 12 or 13 million. You're not going to get full value in this, right? Because if someone's going to come along and acquire it, they're not going to pay full value for it. But I think you're probably looking at somewhere between a 5 and 10 bagger, relatively riskless compared to, comparable projects. So, and then the other thing that's really interesting is Kinross has its Round Mountain mine not too far north of where Viva's Tonopah project is.
25 million ounces, right?
Yep, and they're going to start developing the underground portion of it because they're starting to tap out of the open pit ore, and they've got a huge processing facility. And I think there's a good chance that before Viva sinks money into building a mine, I think there's a chance Kinross takes it over, because you can truck the ore from Tonopah to Round Mountain and process it. So it would make sense for Kinross to do that so that it can, as you know, these processing facilities are most efficient if they're running at full bore, right? And Kinross is going to need feedstock for it. And in my opinion, Viva's project is the perfect source of ore for that.
Is it similar metallurgy to Round Mountain?
Well, they've got an open pit processing, so and that's what Viva's deposit is. It would be open pit, heap leachable.
Any more picks, Dave? Or
yeah. So another one, and I don't know if I've mentioned this in the past. It's been a while since we've done a podcast. There's a company called Angus Gold, and the ticker is ANGVF on the OTC bulletin board and GUS on the Toronto Venture. And it's relatively unknown, relatively underfollowed. They're advancing a high-grade gold project in an area called the Wawa Camp. It's part of the Greenstone Belt in Canada. And it's surrounded by mines that are operated by Wesdome and Alamos. And then I think Argonaut's Mangino mine is a little bit northeast of where this is. So, right away, there's potential acquirers of this project. And they've had some phenomenal drill results. They just raised some capital. They're fully funded for their drilling for this year. There's 2 potential deposits on the property. And management owns 37%. New Gold owns 10%. That's actually where I originally found it. I was reading through one of New Gold's, the transcripts from one of their earnings calls about 1.5 years or 2 years ago. And they had mentioned that they had just invested in Angus Gold. So it's got a tight share structure, 50 million shares after the latest financing, no warrants. The management is absolutely adamant against issuing warrants because they don't want their returns diluted. And they've been able to do financings without requiring warrants. And part of that is because the management participates in every financing that they've done. I can't remember what the market cap is off the top of my head. I think it's about 35 million. And this one, again, I think it could easily be a 5 or 10 bagger.
With geological success, of course, with the drill bit.
I mean, honestly, I don't like to put the cart before the horse, but one of their deposits already has a historical resource. They need to, and they're, I can't remember. I think it's like 300,000 ounces or something like that. Don't hold me to that number. That's off the top of my head. And the drill results are indicating that it's going to be much bigger and higher grade. And then there's another geological formation called a banded iron formation on their property, and they just started drilling that. If they have both deposits, if they can prove a deposit on the BIF and on the area where there's the existing historical resource, I mean, this thing's a grand slam home run.
Dave, when you look at in situ gold ounces in the ground, somebody brought a company to me and they said, Bill, look at this as an optionality play. And I said, it's too small for me to look at as an optionality play. It was like 500,000 ounces. You got something going on geologically, I'll give you that. But I would be more interested in the potential exploration upside if all you have is 500,000 ounces. When I think optionality, usually I think at least 2 to 3 million ounces a company has to have, preferably in the measured and indicated categories, before I would consider that a play on the gold price. Do you view that similarly or differently?
That's a good point, and I'm assuming this was an inferred resource.
No, there was some measured and indicated in it too.
Oh, okay.
So it was proven up a little more.
And then did they have a big property package?
It was decent, but they weren't even marketing it as such. They were marketing at low G&A, proven ounces in the ground. Here's why the gold price will go up. An optionality play, and I was like, it's just too small.
Well, you're right. You can look at optionality as in a couple different ways. Okay, we've got 500,000 ounces, and we think we can grow this into 2 or 3 million. But there's also the gold price optionality. I mean, at a certain gold price, a 500,000 ounce mine is extremely valuable. So, for instance, Viva, they've got, again, I think it's around 675 measured, indicated, inferred. But when you look at the drilling that they're doing, and you look at their land package and you look at the trend that it's on, if they're around long enough before they get acquired to further expand and develop the resource, I mean, I think you're looking at least 1 million ounces here, and it's high grade gold and really low cost to process. So, again, to me, that's massive optionality. And you've had 3 different M&A transactions in that region, in that area, in the Walker Lane trend, that have confirmed my suspicion that Viva's worth at least 100 to 150 million.
All right, before you go, one more pick, or is that good for today?
Yeah, I'd be happy to. There's one that I I started covering, I believe, October. The CEO had reached out to me on Twitter in a DM, and normally that kind of puts me off. But I took a look at their website and their presentation, and I got a hold of him, and he's a great guy, Simon Diakowski, I guess you pronounce his name. It's Aztec Minerals, Cervantes project in Mexico. And I mean, I'm not even going to go into that one because at some point Alamos is going to acquire that property, I'm sure. Alamos is I think they have 8 or 9% of the equity, and they maintain their position, in the financings. And it would just make sense for Alamos to acquire it. And then they've got Tombstone in Arizona, and they just acquired a key land parcel, cheaply too, that they needed so that they can not necessarily complete it, but build out their land pack. There was a missing hole apparently in where they think the geology runs, and now they've got it. And it looks like it is Taylor deposit style geology on the property. And I'm not saying it's going to be as big or as robust as the Taylor, the Taylor.
Yeah,
deposit,
man, you
right?
might want to tell listeners what that was bought out for, just to put it in perspective.
I can't even remember. Was it 1.2 billion?
Yeah, it was like $1 billion. I just had $1 billion in my head.
I've been involved in Wildcat Silver, which was the predecessor to Arizona Minerals, and then South 32 bought them out. I mean, it's a world famous, world class polymetallic deposit. Lead, zinc, silver, gold. It looks like the mineralization and the geology on Tombstone is similar. And again, that's not to say they're even necessarily going to find a deposit. I think they will. But basically, the reason I like Aztec is you've got two horses here. And if just one comes in, you're looking at a home run. And if they both come in, grand slam.
So is that the optionality you look for in an exploration play too? More than one project?
It kind of depends. Again, I hate these companies that have 5 projects and they put a little bit of money into each. But this one, both these projects, and Aztec just did a financing and they didn't have any problems raising the money. These are both 2 highly prospective projects, and the drill results on both have been phenomenal. And so I'm okay if they're developing both at once.
Dave, your journal, the Mining Stock Journal, could you remind listeners what you offer there and how often you issue it?
Sure. You can get more detailed information at investmentresearchdynamics.com, but it's bi-weekly, so it's twice a month on Thursdays after the market closes. So I don't like some subscribers to have an early advantage. The ones who aren't working, and they, if I send it out in the morning, they have a shot at, I'm going to invest in these before the rest of the subscribers, pile into it. And I cover a portfolio of ideas. Most of them I invest in, either myself or my small fund that I manage with a partner. And so I do put my money where my mouth is on most of them. I disclose whether or not I'm invested in it and whether I'm adding to it. And, and I admit my mistakes. I've probably, over the last 3 or 4 years, I've probably had about 4 companies that I've discontinued coverage on. And again, it's, I let my subscribers know. It's like, hey, I'm putting this one on care and maintenance, and I'm going to sell the stock. So just so you know.
And that's part of the game. It's nothing abnormal, is it? It's just part of the game.
It's just, exactly. And I do focus on the high risk, high return junior development stocks. But I also, if I see a relative value idea in a mid cap or a large cap, I'll write about it. One that I recently wrote about was Hecla. And I've just happened to notice over the last year that when the market's rallying, Hecla outperforms. And that's especially true since they acquired that Alaska project, or the Alaska company. That's the name of it.
Alexco.
Yeah, Alexco.
That was a disaster for Alexco shareholders, but it can work out for Hecla, right?
And I was a fan of Alexco because the deposit is so high grade and there's so much room for upside. And I think it's got a 400 ton per day processing facility. I think once they get that thing ramped up and operating efficiently, they'll expand that. I mean, if they double the size of that, the acquisition for them is a grand slam home run. But it certainly adds a lot of high grade silver, and it's basically pure silver. So you've got massive price optionality to silver, and especially with the grade of the deposit. So that's just an example of a larger cap stock that I write about and discuss and talk about my call option strategies.
Excellent. Well, Dave, thanks for coming on the show. It's been a while. It was great catching up with you.
Likewise, Bill. Thanks for having me.